So you're finally ready to buy your first house. Congratulations, that's a big deal. Purchasing a home is probably the single largest financial decision that you will ever make. And your home is probably the most expensive asset that you will ever own. And because of this, it's very important that you actually get things right, because you don't want to overpay for your house. Hi, my name's Ben, and this channel is dedicated to all things personal finance related. Because school may have taught you your ABCs, but it did not teach you how to manage your money. So if you're interested in learning how to earn more, spend less, and invest the difference, then be sure to subscribe as I have new videos every week. But in this video, we're going to be tackling a controversial topic. Now, when I say this is a controversial topic, what I mean by that is people have very strong opinions one way or the other as far as which is the better mortgage type. Now, there is no one size fits all when it comes to personal finance. So after listening to this video, if you still disagree with me, that's great. You can get the 15-year plan if you want. But let me know what it is about the 15-year mortgage that you like, and be sure to leave a comment down below. Now, typically when people say that they like the 15-year mortgage as opposed to the 30-year mortgage, usually they have one of two reasons why they like the 15-year plan. Now, the first reason usually has something to do with security. You can word it a variety of different ways, but they think that the 30-year loan is risky because for a full 30 years, if you stop making payments, the bank can foreclose on you. Or they feel stressed out about having this really high mortgage payment. Or they think that debt is bad, and so they want to just get rid of all of this stuff as quickly as possible so that they can just wash their hands of it and be done with it. And the second reason that people typically give when it comes to why they think the 15-year mortgage is better is that over the life of the loan, they say that they will pay significantly less in interest with a 15-year mortgage as opposed to the 30-year mortgage. So in their eyes, that is a very sound financial decision. But let's take a look at each of those reasons and kind of pick them apart a little bit. So the first reason of security and wanting to get rid of that mortgage as quickly as you can, well, a few things on that. Now, believe it or not, owing a large amount of money is not what makes a loan risky. A loan is only risky if you are unable to make your monthly payments and you then go into default. That's what makes a loan risky, is situations that could potentially cause you to not be able to make those payments. Now, a mortgage payment is typically made up of four things: your principal, interest, taxes, and insurance. Now, I don't know what your insurance is, and I don't know what your taxes are. So in this video, we're going to be only focusing on two of the items that go into your mortgage: your principal and your interest. But with a 15-year mortgage, your principal and interest is roughly going to be 50% larger than it would be if you had gone with a 30-year option. You see, in order to rapidly pay off your loan in only 15 years, that can only be accomplished by throwing a lot of money at your loan and rapidly paying off your mortgage. This causes your monthly payments to be very high. Like I said, they might be as much as 50% higher on your principal and interest. Now, maybe right now you're saying, that's okay, I can afford it, I'm married, we have no kids, and we both have a good job. And that might be true right now. But what about 3 years from now or 5 years from now? What happens when life throws you a curveball? What happens when you suddenly have a child or two or three? What if your spouse gets laid off or hurt, and now you're only operating on half of your total income because you don't have that second person working? You see, it's these kind of situations that cause a loan to be risky. Now, if you look back historically to 2008, 2009, and the mortgage crisis, and if you looked at the foreclosure rates by loan type, you would see that the 15-year mortgage had a much higher default rate, a foreclosure rate, than the 30-year mortgage did. Because at this point, a lot of people were getting laid off from their jobs, the economy sucked, nobody really had a lot of money, and so nobody was able to make these higher monthly payments that the 15-year mortgage requires. Now, it's true, if you do make it the full 15 years without life throwing you a curveball and you have your loan completely paid off, then at that point, your loan is very safe and secure because it's already paid for. The problem is getting to that point successfully can be rather difficult sometimes. Whereas with a 30-year loan, you have a much lower monthly payment. So even if somebody got laid off or hurt and you don't have the same amount of income coming in, there's a chance that you will still be able to afford the lower monthly payments that a 30-year mortgage offers, but you would not be able to make the higher payments with the 15-year plan. Additionally, even if you really like the idea of paying off your loan rapidly, there's nothing that says that you can't pay off a 30-year mortgage rapidly as well. So if we take a look at a hypothetical example of two different loan types, each purchasing a $250,000 home. Now, a 15-year mortgage, interest rates vary, but as of this morning, the interest rate was about 3.15%, which means your monthly payment is going to be $1,745 per month. On the other hand, the 30-year mortgage does have a little bit higher interest rate historically, and currently that rate is sitting at about 3.64%. And that means that your monthly payment is going to be about $1,142, or a $603 difference between the two loan types. But what if we decided to pay off our 30-year mortgage and kind of treat it as if it were a 15-year mortgage? What if we took that extra $603 each and every month and we put it as an additional payment towards the principal balance of our 30-year mortgage? Now, in this case, because we are paying a little bit higher interest rate, we're not going to pay the loan off in 15 years, even though we're making the same total monthly payments of $1,745 under both programs. In this case, the 30-year loan will now be paid off in 15 years and 9 months. So it's not a huge difference, and we're looking at about an extra $13,000 or $14,000 in interest. And while that is a lot of money, it might be a small price to pay for that added security of being able to pay a lower payment, the option of paying a lower monthly payment during times when financially times are rough and you're struggling. And the second reason that a lot of people give of why they like the 15-year mortgage as opposed to the 30-year mortgage is because they say that it saves a lot of interest. And at the surface, that looks like it is very true. So with a 15-year mortgage and your $1,745 monthly payments, if you add up all of those monthly payments over the lifetime of the loan, you're looking at paying about $314,000 in total money towards paying off that loan, that $250,000 loan. So that means over here on the 15-year side, you are paying about $64,000 worth of interest. But over here with the 30-year mortgage and your $1,142 per month payment, that comes up to a total of $411,000 of total money that you're paying for this loan. And that's because of two things. You're paying a slightly higher interest rate and because the time is spread out. So that interest has longer to compound upon itself. So with a 30-year mortgage, you're paying about $161,000 in interest. Ouch. That's about a $97,000 difference as opposed to the 15-year mortgage. So that's a lot of money. So how can anyone possibly justify paying almost an extra $100,000 for their house? So in order to properly justify this, I'm going to break this scenario down into two distinct scenarios. Under the first scenario, let's just assume that you're not very good with your money. So that extra $603 per month that you're not having to pay that higher rate with the 15-year plan, let's just assume that you're basically just throwing that money away. You're going out and you're buying vacations and a second or third big screen TV. You're just kind of blowing through that money. And then the second scenario, we'll assume that you are a more strategic investor and you are planning on actually saving that $603 every month. And we'll look at the two variables and see how they each play out. So under that first situation where you just are going to be blowing that money and you're not going to be using it for anything that's really financially productive, it's still not as bad as it seems. It's still not going to be that $100,000 difference once you factor in inflation. You see, historically, the United States has about a 3.22% inflation rate. So what this means is every single year, your dollar becomes worth less and less and less. And this is important because when we think of a mortgage and repaying a loan, we think about how many dollars are we paying. But realistically, those dollars are worth different amounts. You see, a dollar today is worth a lot more than a dollar 30 years from now, as far as the relative purchasing power that that dollar will provide. And this fact that your money is worth less is important because with a 15-year loan, since you are making a large payment and you're paying it off very quickly, you are using more today dollars as opposed to the 30-year mortgage, which is spread out over time and is going to use more future dollars. And even though the total raw number of dollars that you are spending with the 30-year fixed rate mortgage is a lot higher than with the 15-year mortgage, the value of those dollars really isn't that bad. So let's take a quick look at that. So with a 30-year mortgage, that first year you're making payments of $11.42 every month, and since this is our baseline, our initial starting point on the timeline, those dollars are actually worth the full amount, right? But next year, you're still going to be making payments of $11.42, but those dollars are going to be worth a little bit less. And the dollars that you spend the year after that are going to be worth even less than that. In fact, during your 30th year, your final year of paying the mortgage, even though you're still technically paying $1,142 per month, the relative value of those dollars when compared to today's dollars is only about $442. More than half of the total value has been wiped away due to inflation. So when you add up all of the relative purchasing power that all of these different dollars on both sides, on the 15-year and the 30-year mortgage, would have provided for you, the 15-year mortgage does win, but it only wins by about $13,000 or $14,000. Now, that's still a lot of money, don't get me wrong, but it's a significant reduction from the initial difference of almost $100,000 that we were talking about before we introduced inflation. And like I said, 13 or 14 grand, that's still a lot of money, but that might be worth it for the extra security of being able to pay that lower monthly payment with the 30-year option. Because that way you are better positioned to be able to survive and keep on making payments even when life throws you a curveball and you get fired or hurt or sick or anything like that. But none of you guys fall into that category anyway. Remember, that was for the people that were going to just simply blow and waste that money, that extra $603 per month. Since all of you are watching this video and I know that you care about your personal finances, you're going to actually save that $603 per month and invest it. So now let's take a look at how that scenario plays out. So what we're going to do is we are going to look at both loan types, and we're going to extend it over a 30-year time span. So let's assume with the 15-year mortgage, you're making that $1,745 payment every single month, and after 15 years, your mortgage is gone. So now instead of using that $1,745 per month towards your mortgage, now you're going to be throwing that in some kind of an investment account. Maybe you're going to buy stocks with it. So every month from year 16 to year 30, you're socking away $1,745 into your investment account. Now, the stock market is up and down and sideways, but over the long run, it averages roughly about a 9% annual return. And over here on the 30-year side, you're still going to be making your monthly payments of $1,142 for the entire 30 years. But in this situation, you're going to start saving immediately because you have that $603 every month. So each month for the duration, the whole 30 years, you're going to put in that $603 into the same 9% stock market. So in this example, after the 30 years, we both have a fully paid off house. And we have also been making the same total monthly payments. $1,745 over here for our mortgage for the first 15 years, and then $1,745 to the stock market, as opposed to on this side, the $1,142 for the entire duration into our mortgage, and the $603 into our stock portfolio. So like I said, we've made the same contributions over the same amount of time. Now let's see what those stock portfolios look like, because that's the only thing that's different. We both have a fully paid off house. So over here on the 15-year side, our money has grown from year 16 to 30 to just under $640,000. That's a pretty good investment right there. But over here on the 30-year side, even though we're contributing less, we're contributing it more often because we have been starting at year 1 and going all the way to year 30. So that money has had longer to compound. So over on the 30-year mortgage side, we actually have $1,026,000 in our stock portfolio. That's a difference of almost $400,000 between the two. So even though you technically paid more in interest with the 30-year mortgage, you were able to take advantage of the fact that your lower monthly payments allowed you to invest the difference at a higher rate of return. You see, with a mortgage and your 3 and 4% loans, by paying off your mortgage as quickly as possible, you are essentially saving or earning that 3 or 4% in interest that you no longer have to pay. But 3 or 4% interest is ridiculously low. Like, I can stick my money in just a regular savings account and get over 2% interest. So paying 3 or 4% interest on a mortgage is very cheap money. It's a cheap loan. And so by not paying off that loan as rapidly as possible and just paying the 3% interest, you can use that money to invest in something else and hopefully earn 9%. Now, it's never guaranteed that you're actually going to get this full value. The stock market does fluctuate. Some years it's up, some years it's down. But over a 30-year time span, the numbers are going to probably more or less work themselves out to the historical averages. So between the fact that over the long run, you are probably able to save up and invest more money with the 30-year mortgage, combined with the fact that I believe it is a safer loan product because when life gets tough, you have a lower monthly payment, a more manageable monthly payment as opposed to the 15-year mortgage. So that's why every house that I have bought and every house that I will ever buy has been with the 30-year mortgage. And as a side note, if they had a 50-year mortgage, I would use that as opposed to the 30-year mortgage. So that's going to wrap it up for us today of why I think the 30-year mortgage is the right option for people. Now, if you still disagree, that's fine. Like I said, there is no one size fits all. But let me know what you're thinking and be sure to leave a comment down below. And if you found this video useful, then be sure to subscribe as I have new videos every week. Thanks, and I'll see you all again real soon.